morning, friends. Thank you very much for giving me an opportunity to talk about this, RBI's Financial Stability Report, June 2025. So it will be easy on my part to discuss this, RBI's Financial Stability Report with a very intellectually stimulating audience of this Financial Stability Report, just to avoid the monotony of reproducing what is published in the Financial Stability Report. Then I will give you some theoretical background about what are the models of financial instability. If we really pass this instability test, then our system is really stable. Actually, financial system is never stable. So a robust financial system may have some concerns which are not readily visible, whether our financial system is not only strong but also resilient under the adverse development. So we will also discuss about stress test and network analysis. So precisely there are three things. One is there is no large disruption in the process of financial intermediation. So these things, these are at the back of our mind, that financial stability means this. Means East Asian crisis just threw the world into a challenge. So they wanted to assess the financial sector stability at the macro level. Financial sector assessment program started there. Now financial stability reports, most of the central banks are publishing after the global financial crisis. So regular assessment of the financial sector through EFSAP, which was a part of surveillance of the member countries in every 5 years. Non-member countries can participate also, that is optional. Financial stability report is published by most of the central banks after the global financial crisis. Then improvement in the global financial safety net. Global financial safety net. Now, globally, there is no lender of last resort. Financial Stability Board 2009 is also after the global financial crisis. First, Financial Stability Board, even standard setting bodies include IMF, your BIS, etc. So these people, they are contributing to global financial stability, Financial Stability Board. They are also bringing out global financial stability report. So this is the kind of framework that has developed after the global financial crisis. So people are concerned about financial stability around the world after the global financial crisis. If you come to India, yes, India also, that Financial Stability and Development Council, however, contribution comes from all the regulators. Then they also look after the orderly development of the financial sector, and more important is macroprudential surveillance of the economy. Macroprudential surveillance of the economy, the results are produced or reproduced in the Financial Stability Report. Of course, financial literacy and financial inclusion is also their responsibility. Now, has been strengthened after the global financial crisis in India as well. We have not only FSDC, we have subcommittee chaired by RBI. Other regulators, they also participate to resolve the inter-regulatory issues. Then Financial Stability Report incorporates input from all regulators. Means SEBI, IRDA, PFRDA. So they are also giving their input. Anyway, financial stability is a shared responsibility. That is the conclusion that is coming. It is not the responsibility of the central bank alone. It is a shared responsibility, means a shared responsibility among all the regulators, government, and other stakeholders. The first generation model says macroeconomic imbalance leading to financial instability. Macroeconomic imbalance, saving investment imbalance, external sector imbalance, current account deficit as a percentage to GDP becoming very high. Exchange, these are some of the macroeconomic imbalance in the economy. And your debt unsustainability, this is a macroeconomic imbalance. That is Krugman's theory, 1979. Your global financial crisis is mostly because of adverse selection, corporate leverage, and moral hazard problem. Originate to distribute of your exchange rate. Okay, real effective exchange rate. We have a 40 country real effective exchange rate. We have 6 country real effective exchange rate. Those numbers are available after a time lag. whatever data are available in the financial stability report, I will show you. Speculative attack on Indian rupee is ruled out at this point of time. So our external sector is probably secured in the sense that is most unlikely there will be any attack on Indian currency. Just have a look at it. You can see this number, external vulnerability indicator. Your ratio of external debt to GDP ratio is 19.1%. Debt service ratio is 6.6%, and reserve covered of import is 11.5 in June 2025, and even net international investment position, which was high earlier, is also coming down, hardly $8.7 trillion. Now, if you go by this short-term debt, means Indian financial system, there is no macroeconomic imbalance. Debt was higher than the equity. Since then, debt equity ratio has come down to 40%. If you see the corporate debt to GDP ratio in India, so debt GDP ratio of the household is steadily rising. What about the emerging market economy? Emerging market economy, if you see, after the COVID crisis, the trend has been declining. What are the concern? Concern is this is household borrowing. If you see, housing loan, mostly these are prime borrowers, prime and above, around 69.4%. Sorry, if you see their asset side, deposit was 46.3%. Means Nifty next 50, mid cap and small cap. Here, this foreign institutional investor, they invest 12.8%. Financial stability report, gross NPA, multi-decadal low, their capital to risk adjusted ratio, it has a historic high of 17.3%, very strong balance sheet. And LCR, liquidity coverage ratio, if you see what has happened during last 2 years, it has been coming down, that I have already shown. But this gross NPA is the highest among the public sector banks because of legacy issue. Private sector banks, actually, it shows less. And next is your foreign banks, and public sector bank is 25. Here, this financial stability report is silent about it. Non-performing asset of the agriculture sector is highest. This is my interpretation, not given in the financial stability report. Now, capital to risk asset, the CRAR, 17.3%. So it is the highest. If you see why it has come down, I will show you a little later. But this 3.5% net interest margin is not available to public sector bank. It is 13.6% is high, and return on equity is the highest for public sector bank. Private sector bank is relatively low, and foreign bank it is lower. So it is a demand problem, not a supply problem. Net interest margin is under pressure. I will show you these numbers also. Net interest margin is under pressure. Share of CASA is falling, and unsecured credit, because of this regulatory requirement, it has come down from 27% to 11.6%. Growth is now less. Here, if you see, who is lending too much to the unsecured credit? Private sector exposure is 52.6%. Public sector's exposure is 40.5%. Unsecured loan was mostly given by private sector bank. But the private sector bank, if you see, private sector banks, GNPA ratio is 1.7 lower than, because they are going for loan write-up. You have seen the loan write-up is very high for the private sector bank, and as a result, this GNPA ratio of the private sector banks for unsecured retail loan is lower than that of scheduled commercial bank. And slippages, if you see, this blue line, private sector bank slippages is 78.9%. MSME credit growth has moderated, but it is 14.1%. And micro enterprises, they are taking 49% of the MSME loan. And micro enterprises, this MSME loan that is going, this is what stress asset of the microfinance sector is one of the highest, 6.2%. So this is what is the situation. If you see the NBFC sector, key financial parameter, this is your scheduled commercial bank you have seen. GNPA is 3%, is not that bad at the system level. Net interest margin is 5.2. Growth in retail loan, it is still 21%. Credit growth, total advances as well as retail loan is growing at 21%. Mainly because these NBFCs, they are issuing a lot of debentures and commercial paper, debt funds, and commercial banks are investing. Even if their lending is coming down, their exposure is not coming down. Then if you see the slippages ratio, this non-bank financial companies, upper layer, non-bank financial companies, middle layer, they are rising. Slight increase in the instability can means stability. Non-banking stability indicator has deteriorated marginally for the NBFCs. Systemic risk assessment is done by the regulator, and how they have done, just have a look at it. Impact on the balance sheet, mostly how much of their capital will be eroded, how much NPA will be there. Suppose GNPA will increase, suppose interest rate will increase, suppose equity prices will fall, suppose deposit growth will collapse. What happens to your credit risk, market risk, liquidity risk? For the bottom-up approach, some banks are means regulator has given this type of risk that you try to study how your bank is affected, and they also have their risk assessment. Then bottom up risk assessment sensitivity analysis, that is also there. Some of the bottom up risk assessment is mostly derivative exposure, etc. These commercial banks used to do. The participation level may be somewhat less. It's not complete scheduled commercial bank, and for that matter, all NBFCs, etc. Assessing the resilience of the financial institution to adverse movements in the range of risk factor covering credit. What happens to credit risk? Only 3 banks are probably breaching the minimum capital requirement under severe stress scenario, the sensitivity analysis credit risk. Under severe shock scenario, 3 banks will lose. Gross NPA exceeding 7%, 7.98%, probably 2-3 banks will breach the minimum capital requirement. The banks are the individual banks exposure to individual borrower or group borrowers. If you see, unlike in the Middle East, 3-4 borrowers, they are borrowing 30-40% of this total credit of the commercial bank. There the concentration risk is very high. Here the concentration risk is not very high. Let us see credit concentration risks by group borrowers. Suppose this you have seen, this I am showing, even if the top 3 individual borrowers of all banks will default, means they will slip from balance sheets are so resilient. Now think in terms of group borrowers, not these individual borrowers may not be there. The top 3, it may so happen the borrowers, they might be borrowing from multiple banks. The credit concentration risk index, they have given a box item, how they are computing it. Credit concentration risk index is falling. Then NFSR also 226.3, that is there in this this financial stability report. What happens to, and liquidity will be taken from the bank, the way they are calculating the runoff rate. The runoff rate is, in that situation, only one bank may be marginally missing 100% LCR. Means liquidity coverage ratio will be more or less maintained even under severe stress scenario. That aggregate CRAR of 46 major scheduled commercial bank may marginally dip to 17% under baseline scenario, 14.2% under adverse scenario 1, 14.6% under adverse scenario 2 by March 2027, 2 years horizon. None of the banks will fall short of the regulatory minimum of 9%. That is macro stress test. Sensitivity analysis shows, credit risk sensitivity analysis shows, under a severe stress scenario, system level CRR may deplete by 370 basis points to 13.5%, while 3 banks may breach the regulatory minimum capital requirement. Under severe stress, and 2 standard deviation shock to this, NPA. While no bank will breach the minimum CRAR, credit concentration risk index of the top 100 borrowers is also falling. Means credit concentration risk is less. It is also falling. And the commercial banks are keeping large amount of their investment in government security held to maturity. They are sitting on for market risk also. That due to paucity of time, I am not discussing those things. Then they have done stress test for urban cooperative banks separately, myriad of other stress tests such as interest rate risk, equity price risk, liquidity risk also indicate that India's financial system is fairly resilient or investment and risk diversification. When the financial system matures, capital of the going concern, Tier 2 capital is the capital of the gone concern. So what happens to their Tier 1 capital? Stress test is also done. December 24, then now 19.6% increase bilateral exposure. And here network plot of the financial system, net receivable and net payable. If they will collapse, a bank will collapse, then there will be liquidity contagion. So liquidity contagion and solvency contagion, this type of stress is also given to the system. What happens? Simulated contagion losses due to hypothetical bank failure. If the bank will fail, bank 1, bank 2, bank 3, bank 4, bank 5, top 5 banks. And number of banks defaulting due to solvency problem, none of the banks. Percentage point. Banking system's capital will be eroded to the extent of 2.5 percentage point. Solvency and liquidity contagion will affect the capital of the commercial banks, but the erosion will be not high enough for any of the commercial bank breaching the minimum capital requirement. So there was also a potential risk to financial stability. Potential risk to financial stability amid scheduled commercial banks' robust capital, multi-decadal low NPAs, key areas of concerns are slowdown of credit growth for whatever reasons, pressure on net interest margin, important for the commercial bank. So these concerns are probably not very much visible in the financial stability report. I have found out from their analysis that these are the area of concern for the scheduled commercial bank. Slowdown of the credit growth, pressure on NIM, asset quality of the unsecured credit, large loan write-off, elevated credit growth to MSME, particularly micro enterprises, and a rise in non-housing retail loan to household. Results of macro stress tests affirm that most scheduled commercial banks have adequate capital buffers.
Liquidity coverage ratio at 132.6%. All these, they indicate a very healthy financial system. And Sir has also pointed out certain key risk areas like rising household debt to GDP ratio. And another key risk area pointed out by Sir was the private sector banks are showing high write-offs and slippages.
To go through the financial stability report would have been immensely benefited. That the health of the balance sheet of the banks and BFCs is quite strong. When you were talking about floating rate loans, it is true that floating rate loans is almost 75% of the total advances. But I personally believe all floating rate loans of the banking system are not linked to external benchmark. You are talking that micro enterprises, is true that there is a lot of stress that we face in our loans to micro enterprises, but
also MCLR marginal cost based lending rate, it has also come down for many banks. That is one thing.
But when
anyway, the NIM is under stress. Net interest margin will remain under stress at least till the deposit cost is reduced.
Your observation is very valid, but it is more in the context of, I think, retail loans, personal loans, unsecured, that segment.
His question is regarding NIM. What should be the benchmark as a balance between the depositors and borrowers with less commercial interest of banks?
So the question arises whether for extending banking services in India with a large spread so much, so that you are only want to maintain this kind of a 3 to 5% one. Now, when the interest rate across the board is coming down, is the continuance of 3 to 5% margin, net interest margin is justified? Number one, I feel a lesser net interest margin will be more helpful for the quicker development of the GDP and the growth of.
Okay. One clarification, 3.5 is scheduled commercial banks net interest margin. For private sector bank and foreign bank, it is 4.1%.
Almost more than 20% of the banking sector's contribution is there in the NBFC sector. There also, the net interest margin is to be brought down to see that these institutions, no doubt they are commercial to keep the private interest in that intact, but net interest margin will, across the board, entire population, it will be beneficial.
That is what is the issue. Net interest margin is under pressure mainly because the high cost fund. That is what actually I wanted to say, that commercial banks have to probably diversify and non-interest income should constitute the increasing so that
course,
they can survive when there is pressure on the net interest margin. Net interest margin is profitability, no doubt, but they have to rely gradually more and more on non-interest income.
Which is a welcome thing. Government also has suggested. So this is a welcome thing. That also will put pressure on net interest margin of the banks. That is the margin. Because State Bank of India's amount of minimum charges is very high. I don't want to tell the number, but it is very high. So therefore, that is a good relief which has recently been brought out.
Let me confess to you, I am one of those who regularly read the reports of RBI, whether it is trend and progress or financial stability.
That has been valuated, overvaluated. That give rise to that crisis basically. And also there is a term ninja loans, that no income, no asset, no jobs, and they have also been given the home loans just on the valuation of the house that they are purchasing. Today, although the FSR is talking about that the average household debt is under control and it's not a things to worry, but as a ground level banker, I'm seeing that even the banks, commercial banks, are lending on the market price for house loans and mortgage based loans. So it is not going to create a further situation arising some credit risk and market risk in future.
Prices are rising rapidly. Suppose prices will fall, that's why loan to value ratio gap, so that the exposure of the commercial bank to this real estate will not create problem going forward. That is one issue. Their paying capacity is not bad and the default is less. Retail loan, if you see.
For your question, any more questions from the audience or anybody wants to make an observation, you're welcome. More importantly, the membership provides you with exclusive opportunity for networking with senior bank executives across the country. We come to end of today's session. Thank you once again for joining us. Wish you a very wonderful and productive week ahead.